Hello, Kurt Jackson, Retirement Income Strategist with KJ Financial here with this week's installment of Your Money Matters. We're going to continue with our series from True Confessions of a Traditional Financial Planner. And this week's is and actually next week's going to be a little two-part inside of our series is on financial insanity. I'm going to shoot them both today because I'm going to be gone the next week in Des Moines with my oldest daughter for her softball World Series. So I'll shoot them this week and post one this week and one next week. So let's talk about financial insanity and what is so wrong with typical traditional financial advice anyway. We're going to begin to explore some of the common problems that we find with traditional financial planning. There's more risk and less control. See, traditional financial planning assumes that you're going to lose money. They assume that, and that the more you're willing to lose, the faster your portfolio is likely to grow. But is this really true? See, we've been conditioned by risk assessment profiles to think safe or predictable equals a low return on investment and high risk equals high reward. But perhaps the more we're willing to tolerate losing, the greater chance we have of loss. Okay? See, we're conditioned to believe that we must take bigger risks if we want a chance to earn higher returns. But again, is this true? Or are there alternatives to the stock market risks or cash equivalents that grow at a snail's pace? See, traditional financial advice presents limited options. Essentially, the question on the risk tolerance forms are asked to determine your appropriate ratio of stocks versus bonds, as if stocks and bonds are the best or only valid investments. See, my own personal risk tolerance is zero. I have no tolerance for losing money, either mine or my clients, right? But traditional advice is predictable. See, unless you're very close to retirement or extremely risk averse, you're told that you'd be better in mostly stocks or in stock mutual funds rather than bonds. And not that we're advocating either of those as a solution. So, unless you have the ability to earn or save or perhaps inherit very large sums of money, traditional financial planning offers you really no options to grow your money other than to place it into the Wall Street casino and roll the dice. See, when it comes to your future and your hard-earned money, do you really want to rely on speculation, hoping that shareholder prices rise instead of fall? Or would you prefer vehicles with predictable gains secured maybe by real assets? This is kind of funny, the stuff that she talks about here is the money managers versus the monkeys. And see, we're not really literally gambling in the stock market, right? I mean, you're placing your money with established firms that employ professional money managers, and surely they know a thing or two, right? Actually, many stock-picking contests have demonstrated that portfolios chosen by monkeys, cats, random darts, fourth graders often outperform professionally managed funds. The truth is that nobody has a crystal ball, and the market is very unpredictable. The monkeys may also have an advantage because they're not charging any fees. The great majority of stock brokers, money managers, financial analysts alike were actually surprised by the big crash that we saw that began in late 2007 and it ended in the beginning of 2009. That fact ought to raise serious questions about why you're actually paying fees to those people to pick your stocks and to guide you in the first place. Okay? Furthermore, that ambush of the 2008 stock market crash should call into question what the role of the financial advisor should be. Since few planners are effective financial psychics, and really, should we expect them to be? Should we expect anybody to be? Perhaps they ought to be directing us to investments that aren't so volatile in the first place. While it may seem logical for the financial experts among us to protect our money, we shouldn't expect that financial corporations that make billions and billions and billions from Americans risking their money will lead that charge to change. See, you made to feel like you're doing something risky or even foolish if you insist on controlling your own money. But is it really risky to insist on providing your own financing to starting a business, to build your own income, or to buy assets that you can see and understand. Never mind that you can receive healthy returns and even steady payments with these lesser known strategies. Never mind that the historical safety of performance is often better for folks that utilize our alternative retirement strategies than the investments that the financial corporations are trying to sell you. After all, your inner skeptic may ask, if these alternative investments actually worked, wouldn't everybody be using them? So we've been conditioned to be skeptical towards the financial choices that actually make more sense, but not to question options that offer investors poor or unpredictable results. See, when you're faced with a decision to sink your hard-earned dollars into stocks that you can't control, and funds stuffed with financial instruments so complex it takes multiple PhDs to comprehend, remember the question your mom used to ask you. If everyone else jumped off a cliff, does that mean that you should too? See, if you follow the admonitions of max out your 401k or other government-approved qualified plan, you're actually losing control of your assets to the government, the stock market, and the rules of your employer. So you defer income taxes until retirement, when you can afford at least, give up what could have been lesser capital gains taxes, pay layered and overblown management fees, which drain enormous amounts of money from your retirement plan. Just how much will you pay in fees and taxes? Right? You're likely to pay more in income taxes than your total contributions were to your retirement plan. So now this is because deferring taxes in qualified plans means that you're going to pay taxes on the harvest and not just other than just the seed. See, it's true that by putting pre-tax dollars into qualified plans, you'll have more money growing for you. See, and the planners and managers who skim fees from it each year, along with the government that waits for its share in taxes. But you're running unnecessary and likely the risk of higher taxes in the future. It also means that you're going to get hit hardest if you have to withdraw money in a down market, which we see a lot of. See, the typical strategy also psychologically fools you. It fools you and investors into thinking that they have more than they really do, because a good portion of the money in your retirement account is going to go to pay future taxes and fees. It also gives people a false sense of security. As my example of qualified retirement plans, she wrote a book called Busting the Retirement Lies. She found that you can end up paying out as twice as much in management fees and commissions than the amount that you're putting into the plan. And yeah, that's in addition to that inflated tax bill. See, the numbers are quite shocking. See, retirement contributions totaling $400 grand can generate $575,000 in management fees, assuming an average return of 6%. At an average return of 8%, the qualified plan gives up a whopping $834,000 in lost wealth due to these fees. Now, how's this possible? How can you contribute $400 grand and pay $834,000 in fees and lost wealth? See, the example that she used was a 30-year accumulation, 20-year withdrawals, and a total plan management fund fees of just 2.5%. Most people think that they're paying less in fees, but that's actually below average. Forbes and Morningstar did a study in 2011, found average fees inside of a mutual fund are 3.17%. Okay. So, and the reason why is there's a bunch of hidden fees that they don't have to disclose or don't have to tell you about up front. Okay. And then paying these bloated fees is a common occurrence, because compound interest doesn't just grow your money, it also grows your costs as well. John Bogle, the founder of Vanguard, a huge mutual fund company, called this the tyranny of compounding costs. And the results are staggering to comprehend. It's no wonder Wall Street spends billions lobbying the Department of Labor to authorize automatic 401k contributions. Worse yet, even though it's your money, you can't actually use it while others are profiting from it. You have to follow your employers and the government's rules on what you can and can't do with your money. For instance, you can't leverage or borrow against your money in a retirement account to use as collateral for major purchases or to seed a business, for seed money for a business. It's true that you can sometimes borrow for certain limited purposes as long as you pay it back according to the rules. You can also often withdraw funds and pay the penalties as well as the taxes in the process. But in doing so, you're also giving up gains that money could have earned. See, that's the interest that your money could have earned. The money that you could have earned is what we call opportunity cost. All right, so that's going to be where we end for the day. We're going to pick up the rest of this one for next week. I want to thank you for tuning in. I hope that you're following along with this. This really goes along with the stuff that I've talked about for years now and showed my clients for about 12 years now. On all the devils in the details when you start to look at how money works, how retirement plans work, taxes, fees, all of these things that we're never really told about or we're very seriously misled about. Okay, and what we're seeing is an absolute failure of these 401ks, 403bs, 457 plans, IRAs, all the fact that since about 1980, 81, 82, 83. The government has taken the pressure of providing a retirement from the companies and put it on to you, the novice investor. And then we're basically swimming in the ocean with a bunch of sharks because those folks from Wall Street and all those places understand money better, and they know how to rig the system and game the system against you. So keep these things in mind. If you'd like to explore some alternatives, we definitely have those here with KJ Financial. That's why I'm an alternative. We talk about alternative retirement strategies all the time. And there's some really phenomenal strategies that give you so much more flexibility and safety and do more for you. Multiply what your dollars will do for you. Much more efficient way of doing things. So hope you enjoy these. If you found value in today's, please share it with your friends, family, coworkers, anyone you care about. Make sure you check out Facebook page, LinkedIn page. Or you can even go onto my website. We're doing a new contest now where each week we ask one financial trivia question. If you get it right, you're entered into a chance to win a dinner on me for that month. We'll give that away once a month. It's a $100 gift card to a local restaurant. So look forward to maybe trying to throw your name in the hat, see if you can't qualify to win dinner on me. But if you ever have any questions, my contact information is up there on the screen, and I look forward to hoping to have the opportunity to speak with you soon. Take care. Have a great week.